Hey everybody, David Skritka here at Stock Chart of the Day. So we're going to show you a kind of interesting chart today. We're going to talk about the Buffett indicator. So for those of you who are unaware, the Buffett indicator is essentially uh, shows the market cap of all stock indices or the World Share 5000, etc., and compares it to the U.S. GDP. And it's basically comparing the size of the stock market to the size of the economy. It's known as the Buffett indicator because supposedly Warren Buffett really likes this indicator. Because I've always talked about this in the past. Actually, my two favorite indicators are this and price to sales. And the reason is with financial engineering, stock buybacks, et cetera, companies can kind of inflate their earnings per share. But sales are your top line growth. You can't really hide that. I guess you could do takeovers and M&A to increase sales, but even then you would dilute your stock or take on more debt. So you either have to grow organically with sales, or this just shows you the size of the economy compared to the size of the stock market. So basically, or the size of the stock market compared to the size of the economy. So basically showing you what the equity markets, and a lot of people would not consider the equity markets to be quote unquote real in the sense that, it's mostly wealthy people involved in it. It's people sitting around maybe day trading, et cetera, where the real economy is, bricks and mortars, construction workers going to site, people serving you your coffee at Starbucks, et cetera. That's like the real economy, working class people, even white collar people, accountants, whatever, day-to-day work. So you can see right now that the market cap is over 56 trillion, which is incredible in itself. It's actually, I think the US stock market is over 50%. I think it's roughly 100 trillion on the global markets. And the US economy, which is about 20% of the global economy, is over 50% of the the stock market, global stock market size. And then you see the economy is about 28 trillion. And this is a huge number because, as we can see right here, we're nearing 200% of GDP. So you may ask to yourself, why is 200% so important? Well, 200% is the all-time high. Look, you see 199. So we're at 199 now. 200% is what we hit back in 2021 when the Fed printed trillions of dollars, rates were zero, and we inflated this huge stock bubble. And back then, of course, it was more like it was just all these little tech stocks. Like one stock I've traded in and out of, many is Fubo. Like Fubo, for example, was a $50 or $60 stock back then. Fubo is like $1 to $2 now. So those were the kind of stocks, like really anything that, Fubo is a streaming service, anything that kind of benefited from people staying at home, from lockdowns, from COVID, these little tech companies absolutely soared. And of course, the Microsofts and Amazon and all the big tech companies did fine, but this has been more driven by what the so-called Magnificent Seven, et cetera. Oh, we have seen a broadening of the rally. I'll talk about that in a future stock chart of the day. But the question what we must ask is the broadening the rally happening because we're in this final stage of the blow-off? No, I know that many of my subscribers are probably more conservative, would probably be more pro-Trump, et cetera. But look, you have to look at the valuations, and the stock market did very poorly under Bush. Right, the stock market crashed, in 1929 under Hoover. So it's not just like those. That does not just drive the stock market. I would consider both Obama and Biden pretty anti-business, anti-free market type presidents, and the stock market did great. Part of the reason being there's been this rush into the Magnificent Seven now. And under Obama, there were zero rates and trillions of dollars printed. So it doesn't really track. And also, too, we're at an all-time high. To stay at this all-time high and not go above the 2020 high from this period on, let's say Trump can grow the economy at 5%, which would be absolutely unheard of right now with the size of the U.S. economy a year. That means the stock market can only go up 5% a year to basically not go above those all-time high valuations. So we're pricing in perfection right now. And it's always dangerous because the last time, when I thought this was going to be the all-time high, we've never seen again. You can see we went to about 140. I think actually the actual intra-month high, because these are, you see, end of months, in I think March, at the beginning of March or mid-March when the stock market peaked, I think it was close to 150% of GDP. And 100% used to be considered very high. Like in this kind of rebound rally, we again went over to 100%. Really, I think in 1929, it got to almost 100. Before the last 10 years with all this quantitative easing and financialization of the economy, what we used to see is 100% was almost unheard of. And you can see in the early 80s, we were at like 30, 40%. And actually, what's interesting is the last 20 years, the median has been 97%, which used to be like the all-time high. And before that, the median was around 60 to 70%. So the last 20 years, the median has been much, much higher. And again, we can kind of see this here that, you know, when I started getting, I know a lot of people consider me a perma bear or whatever. This is why I started getting worried about the market way back in 2014, 10 years ago, because we got up to 140% or 14% of GDP, which again was unheard of. Other than the dot-com bubble, never been that high. But we've managed to basically stay above this 100% level for, you know, 10 years. So at some point, this will change. This cannot go on forever. Just like in the 70s into the you know, early 90s, we were below the median for, you know, 20 years. Now this has been above it for 10 years. You know, we were basically below 50% stock market to GDP for most of the mid 70s to early 90s before that big boom of the late 90s. So at some point this will change, and now we're basically at completely nosebleed level. So you combine this with, this is an interesting chart. This is an excellent site. It's called Bar Chart. I really like their Twitter feed. And this shows the asset managers and what they're doing, U.S. global futures, index futures. So they have the longest position in history. And we can see is, you know, after the market had this correction in 2015, 2016, they were barely long. And then we basically had a huge rally into the beginning of 2018 after that, like a rally that lasted basically 2 years. And then again in 2020, they got pretty, you know, they had barely any longs. Of course, that was the bottom of COVID. And then 2022, they barely had any longs. And then we've had this huge, roughly 18-month rally, 18 to 20-month rally since then. And you can see the last time that they were this long was early 2020, right before the market smashed during COVID, and like mid to late 2021, when the market entered a bear market in 2022. So you combine that with, like, it looks like people are too positioned too bullishly. And then you also have the stock market cap to GDP at these nosebleed levels. It looks to me like we're going to see some kind of top here. And I know the breadth is widening on the market. We'll talk about that in another video. But you have to take in sentiment, and at the very least, we need a correction. But like, look, I'm just going to tell you, other than, you know, a few beaten up plays, now is not the time to be buying equities. This chart just tells you all you need to know. You know, even though it didn't get to cheap levels, you can see back in 2021. Now, granted, again, it doesn't work out perfectly. In 2021, it peaked in the summer in July. The market kept pulled up into December. So who knows? Maybe the market will keep up, you know, or prop up for the next few months. But, you know, we saw, I think, a roughly 25% decline in the S&P in 2022. And of course, in 2000, we saw a decline that was almost 50% in the S&P. In 2007, it was over 50%. So, you know, right now you can see this from the metrics they have over here. Anything under 83%, I actually consider it under 60%, because this is now, you know, skewed by the last 10 years of these huge, you know, valuations. You can see is undervalued, 80 to 100, moderately undervalued. Yeah, see, I would consider this overvalued, but anyhow, but definitely over 140% is significantly undervalued. I would say over that 130%. I would say even over 110, because considering that there's only now 3 times in history, 2000, 2021, and today, that we've been over 100, say 25% of GDP, I would consider it to be significantly overvalued. So, and a lot of this just has to do with the mass participation in the markets, people doing mass speculations. You know, we've got these massive 7 companies that like are a huge part of the index, et cetera, et cetera. So I just thought I'd show you this. And you can see here's the predicted returns going forward here for this sort of thing. And you can see that right now that so the red number is the 20-year average, blah, 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 current. So the current right now would be like, the 20-year would be like, is actually, you're predicting that it would go, the the market's going to return negative 0.35% a year. So that just tells you what happens. Whereas, like, you can see, like, when it was back here in 2009 at the bottom of the market, if you would have bought then when that stock market capped at GDP, I think it got into the 60s, your 20-year predicted return would have been 17% a year. And of course, the S&P's gone from 666 to 5,600. So this thing does work. And again, it's a long-term indicator. It's not something that's going to predict the price of the market tomorrow, but I think now it's just really showing you. And like I said, that's why I'm a conservative libertarian, whatever you want to call it politically. So I would probably agree with a lot more Trump's policies than Biden's, but I also look at valuations and I know that it doesn't really matter when you're at these nosebleed levels, you know? So, and again, we're going to look at some other scenarios going forward. You know, I've talked about this 87-29 thing. Well, there's other scenarios that also often can happen too, like Nixon, for example, 1968, or Reagan in 1980, where the market actually, because on, again, what's perceived as a more, say, free market candidate, pro-capitalist, pro-market candidate, kind of peaks right after the election, and then enters a bear market. That happened in both 1968 and 1980. So we'll kind of look at that in a future video as well. But, and then for my paying subscribers, I'm going to do a really detailed, maybe election cycle video, etc. So anyhow, I just wanted to show you this. The Buffett indicator is again showing us we are massively overvalued on the stock market. And like I said, I know it's not perfect. Like, yeah, like one reason I missed out on a lot of the gains of the stock market, you know, is because it got massively overvalued back in the late 2020s, but there April 20 teens. There were other factors to take hold of back then. Is, you know, the Fed had the rates at zero. They were printing trillions of dollars, and that's probably what allowed us to get to this inflated level, right? So, so that's just something to look at, and the market's basically pricing in perfection at this point. And like I said, it's nice to see the broadening rally, and maybe that means it has a little more legs shorter term. But right now, like I said, I think it's a time you should really be getting defensive here, you know, because this kind of mass overvaluation has only been seen once in history. And, you know, we saw a pretty good drawdown in 2022 after it happened. The NASDAQ dropped, I think, roughly 30% in value. Like I said, the S&P dropped over 25%. So I hope you enjoyed this one. I think this was a good one. Yeah, I think it was pretty smooth, and kind of the simple thing tells the story. So everybody take care, and have a great Tuesday.